Hello. Welcome to the Altitude Homes Podcast, episode number 2.
Yeah,
I'm John Hurlbut. I'm your host, and we are joined today by Steven Wright from the Wright Group at Movement Home Mortgage, and of course, my partner in crime, Jordan N.C. So, Jordan, how are you tonight?
Doing fantastic. How are yourself?
Good. I'm excited about this. So, this is our second live broadcast and our first guest. So, Steven, you're going to go down in podcast history as the first guest on the famous Altitude Homes podcast. So, just take about 15, 20 minutes or so. Tell us about yourself. Why are you in this crazy industry we call mortgage, and how'd you get there, and where'd you come from?
Absolutely. So, if you know me, I'm going to talk for about 1.5 minutes about myself because it's the worst thing in the world to me. But basically,
a little bit closer to the mic.
Sorry. So basically, I started a little over 14 years ago. So April 2008, which is crazy if you think about what was going on in real estate. I decided to have the crazy thought and said, hey, I got young kids, wife.
Why not?
Salary. I don't need those things. I'm going to hop into the mortgage business. All my friends have been killing it for years. They told me how amazing it is. It's got to be great. And then I walk into this, basically a burning building of people screaming and running out.
Right.
Banks imploding every single day. And I'm like, my gosh, what the heck did I just do? I left a really comfortable bank job, and now I'm doing this mortgage thing. So that was 14 years ago. Obviously, it's been good because I'm still here.
Right.
So
one of the best.
I love it. Wait, yeah. I'm one of the best?
Yeah.
Oh, I appreciate that. Thank you.
So you jump in 2008, and the housing market is falling off the cliff.
Yep.
How do you even get in and even get established when that's happening? It was a great time for buyers. Let's not right. It was horrible for sellers. So you had people that still wanted to buy, and house prices were falling off the cliff, and so. What was that first couple of years like before you really got established?
It was tough. It was a grind because basically I had sat as a business banker in Wells Fargo for years. And so I'd met all these amazing business owners, and all my friends had told me, hey, all you have to do is take these business owners that don't really show a lot of income. And we have this stated income program. So just grab all the people's names, hop to the mortgage side, and you can do all these stated income programs. Well, as soon as I got with this big stack, they said, no more stated income programs. Right. And I'm like, but I have all these cards. And so I figured out pretty quickly it was hustle time.
Right.
We actually made a game of it. My kids were pretty little. And so we actually made a game of it. My kids would point out open houses whenever they saw a sign. And I would stop. I'd have to stop. And I'd go in there and have to talk to them about something. So I just started talking to realtors, started meeting realtors and just having conversations. They'd say, hey, come sit in open house with me. Hey, come sit a broker's open with me. And I said, okay, let's do it. Let's go talk to people. It's the fun part of the job. And so that blossomed, but that was obviously the first few years was that. It was trying to make relationships. It was trying to build that whole thing of the actual career that has turned out fantastic. So
very cool. Very cool. And so was it like Impractical Jokers? Like the kids would give you something that you had to say when you walked into the open house?
No, that would have been actually pretty cool. I just had to figure out, what to say. It was, hey, how's it going? Like, what do you think? And just people I figured out in that market, especially just wanted to talk. Like they wanted to tell us what's going on. And here's the struggles that we with. And so eventually it was, hey, I have this really tough deal. Like, do you want it? Yeah, heck yes, I do. And so I became early on, I was the guy that would pour through guidelines. I would learn guidelines. And I would, at that point, it wasn't so much online. It was a lot of books. So we had big blue books. We had one for FHA, one for VA, one for conventional. And I would go photocopy it, and I would help people win. So they would be like, hey, they're pushing back on something. Can you help me find this guideline? And so I started doing that. And still to this day, that's part of the thing that I do is I love guidelines and I love helping people solve the problem. So it started early on, and I still have it to this day. I still love that part of it. So
it's very cool. You're already getting a shout out on Facebook.
Oh, that's nice.
So we have somebody say, Steven.
Thanks, Mom.
I know, right? Yeah. Right. So cool. All right. Well, so we're kind of going through a little bit of a shift in the market right now too, right?
Right.
So probably the big question that's on everybody's minds, like, what the hell's up with mortgage rates?
It's over.
Yes.
All over.
Yeah.
Right?
Yeah, absolutely. We get that question all the time. Or people don't ask the question. It's even scarier because then they turn on the news. They talk to a friend's friend who bought a house 9 years ago. And all of a sudden they have some misinformation. So when I started in 2008, I remember calling people and I would say, hey, you're looking to refinance. I had the script that they had taught us, and they said, call me when rates are under 6. And I was like, That's never going to happen. So here we are again, right? Somewhere similar, obviously, right? Five,
Right.
sixes kind of ranges day to day. They're definitely higher than what they were in December of 2021. We were in the threes, and make no misnomer about it, right? Pierce County, Pacific Northwest, our houses are pretty expensive.
Yeah.
Right.
So if you take a person from 3% on a $450,000 house, now you take them to 6 or 5.5, it makes a big jump in payment. So it's
Right.
a lot of it of that has been clients that we get pre-approved, and they're just, hey, kind of watching and feeling and just making sure that, the house price and better yet, the payment part, which we love to talk about, works for their budget. So
Right.
we have a lot of people on the sidelines right now that are just kind of waiting for it to fit in their budget, which we totally get. Like I always say to people, hey, 6 days, 6 weeks, 6 months, hopefully not 6 years, but maybe
Right.
we'll still be here. We want to earn your business. So we're always here to answer questions. And we get people all the time that every couple of weeks they'll call me, hey, are rates any better and things like that. So, I mean, the good news is that inflation, which the government's scrambling, trying to figure out right now, we know that once they do figure that out and that comes down, we've seen historically rates come down with that. So
Right.
we might not be in these 5.5%, 6% forever. There could be some reprieve from that in the future. We just don't know when. So we don't
Right.
have that crystal ball. It's not fired up. It's not working yet, but maybe one of these days.
Right. Yeah. And we've been, we've been putting out like a lot of infographics. Realtors
Yep.
love infographics, right? That say historically during a recession, interest rates tend to come down.
Right.
And so at least for the last couple of recessions, minus maybe even, in the 2008 to 2012, I mean, interest rates were historically low. We got tired of saying, rates are historically low. They
Yeah.
can't go any lower. And then next week they were like a quarter point lower. And it's like, okay, just kidding.
Yeah.
Right.
Now
So we
they're
did that for
okay.
like 4.5 years. And it was like, okay, no, really, now they can't get any lower.
Right.
Like
Yeah.
we were like, yeah, the borrowing rate were like, we were expecting the next thing is the Fed was just going to pay you to borrow money.
Exactly.
Right?
Yeah. Yeah.
Like, so
It's
they were
too much
lending
of
it out
this.
at 0%.
Right.
Right. And so it literally couldn't go any lower. And then it did.
Yeah.
Right. So I think everybody's tired of that. Well, it can't go any lower and it can't go any higher. And it's like, just talk to somebody like you that monitors that every day. Like it looks like Christmas on your screen every day because you've got the
Yeah.
little red and green bars that are going up and down everywhere.
Yeah.
And those rates change 100 times a day.
Right.
It
And
seems like.
everybody's scenario is different, right?
Mhm.
So your neighbor could have a different credit score. They could have a different loan program. They could have a different down payment. So there's so many variables that go into it, not just the day to day of what rates are doing, but everyone's specific scenario could be so different. So that's why I always encourage people, hey, just talk to us. Obviously, we won't force you to do an application. We've heard of some people saying, hey, we're not going to talk to you until we pull credit.
Mhm.
We can have hypothetical conversations. And a lot of times that gives people the peace of mind to either say, okay, we're going to wait a little bit, or they say, all right, that's what I need to hear. Let's go.
Right.
Let's go forward. So, I mean, rates are what they are, and we don't make any excuses for it. We can't control it.
Right.
We just kind of tell them, hey, here's what that means for you. Here's what that means in terms of purchasing power. Here's what it means in terms of payment. And that's obviously the big part about that.
Right.
We never forget. Most people don't remember what rates they have currently, but they'll always remember their payment.
Yep.
So the payment makes the most difference.
That's
Right.
what's great
So-
about it. It's set for the next 15, 30, whatever you get. It's
Absolutely.
set. That's it.
Yep. That's it. Because we keep seeing rents going up 8%, 12%, 6%, especially in our area. So, we see that rents continue to go like this, where if you buy a house, it might be,
Yep.
a little bit more stable in terms of an outgoing monthly payment. So,
Right. Well, and I think the thing that people fail to realize too is, and we kind of make a joke out of this, and it's really true. It's not a joke. And when you put it in this perspective, like if you're really concerned about rates and you're renting, what's your interest rate on your rent?
yeah,
It's 100%, right?
right.
Right? Because you're not getting anything back for that rent. You're paying somebody's mortgage. It's just not yours.
Mhm.
Right.
Right. So yeah, and I think the thing that I love too is like we'll never tell somebody you can't buy a house.
Right.
Right. It's always, maybe not right now.
Right.
And we'll come up with a good plan, and you've got, amazing tools to be able to say, okay, here's where you're at now.
Right.
We need to do this with this credit card, or do this with this car loan, or, remove this medical thing or whatever. Once we get that, then we can get your score up to this and, move you forward down that path.
Absolutely.
So I think that's the cool thing.
Yeah.
We have our first question in the comments. So what type of credit does it take to purchase a home?
That's a great question. So I don't know there's a one size fits all of that because we get these questions a lot. There are some cases where no score, you can buy a house. So not meaning that you have a bunch of collections and your score is really, really low. I mean, truly like you've never had it. We have a lot of people that call me in there, hey, I've paid cash my entire life. Like I don't have a credit score. I don't owe anybody money. The good news is that
like those
person,
good Dave Ramsey people.
Absolutely. So those people can absolutely, in most cases, you know, obviously other things are in play, but at that point can buy with that. I would say for the most part, kind of the sweet spot is usually 620 plus.
Okay.
That's going to open up, you know, most conventional stuff. It's going to open up down payment assistance, which is huge in our state. It's going to open up a lot. You can definitely go lower than that. We've had people, you know, into the low fives and stuff like that. Obviously, it's not a guarantee when you're in those lower ranges that you can qualify.
Right.
The box gets a little bit smaller for qualification purposes, but it's still possible. And worst case, if you're in that realm and we can't get you qualified, it's pretty easy for us to come back and say, give a game plan, right? We can take the credit, run it through a simulator and say, okay, if you do X, Y, and Z, if we pay off this debt, if we can give them a game plan that might take a little bit of time or take a lot of time, depending on how far we're going, that can definitely get them into the buying realm. So
Okay.
yeah, everyone's situation. And again, it also depends on where you're getting it from.
Sure.
A lot of people will pull Credit Karma and we say, hey, Credit Karma is a great tool to not have your credit pulled. It's great to kind of keep a pulse of what's going on. You can see what stuff's open, what your credit limits are and things like that. But the scoring model is completely different.
Right.
So if you're, I mean, they go up to 900, I think, on Credit Karma. Our normal bureaus do not have that.
Yeah, like 850 is kind of the top end of like
Absolutely.
the three major.
Yeah,
Right?
it ranges by a few points between each of the three bureaus. But that also makes a big difference too. So a lot of times it's like, hey, where did you get the score from? Why do you think you have that score? Just kind of ask some questions and try to figure out where it's at. So I would say the short answer to that, the long way around, was 620 plus is kind of the sweet spot for most stuff to open up. There is definitely possibilities to be lower than that. And we know that a zero credit score is still possible.
Okay.
So
you still need 20% down to buy a house, right?
gosh, that'd be crazy, wouldn't it? I'm like, man, I bought my first house way less than 20% down. So
Mine was 3% down FHA
oh,
before it was even 3.5%.
absolutely.
So,
Little throwback there for John.
Yeah.
So mine was 3.5%
I'm
FHA.
52 now, by the way. So,
Don't look at it. That's all that matters, right? 25.
Yeah,
25.
right,
That's all that matters.
All right. You're our next guest, too.
Yeah. So no on the 20% down. Like I said, down payment assistance is huge. We utilize it a ton. We were actually featured on down payment assistance as one of the top lenders for Pierce County last quarter. So we do a ton. So with that case, I mean, if you make less than 160 grand, you have a 620 plus credit score, don't have to be a first time home buyer and buy anywhere in the state of Washington, they'll give you your entire down payment. So in that case, you technically have a down payment, but it's not your own funds.
Right.
So beyond that, I mean, VA, obviously VA and USDA, which USDA, a lot of people say that's the beef place, right?
Yeah.
That's true. But they also have a home ownership part. So VA and USDA in some cases can be zero, so no down payment. Conventional, if you're first time home buyer, could be 3%, or in some cases 3%. FHA is 3.5%. So a lot of ways for you to get into the home,
right?
Take advantage of the blessing that we have in terms of appreciation of homes in this area, thank goodness. And then, start whittling away at
Easier for
what
you
you
to
own
say.
the home, right?
Well, that's what I love to say to buyers. I'm like, once they close on something, like, congrats, you're in the club now.
Yeah.
Especially just being in Washington where prices are always going to go up and our appreciation is almost double a lot of places.
Yeah.
Like,
Let me take you back to 2009, son.
like-
You heard it here. Jordan said they're
They're
always going to
gonna
go up.
right?
Remember that?
Yeah.
Print that. I
Well,
love that.
they still went up.
Yes.
Well, yeah, after they fell for
Yes. Yeah.
4
That
years.
was
Yeah.
definitely a different time. But yeah, I mean, historical, they're saying, appreciation 2 to 4% or 4 to 5, depending on who you look at. So yeah, you get that growth of what your home's worth. And as you're paying it down. So yes, you can go much less than 20% down.
Okay.
Well, going off of what you said, let's go back to 2009. Why isn't that happening right now, Steven? I thought it was all going to crash. And where's the free houses at?
So the inventory part, obviously you can talk about, right?
Right.
In terms of what we had in inventory versus now versus then. The lending part for us, completely different. Like in that world, it was like I was joking about the stated income. Like you could literally walk into a place and say, hey, I make 10 grand a month, no matter what your job is, and you get a home. So we definitely moved into after 2008 and beyond of full documentation. We ask for W-2s, pay stubs, names of firstborn, blood type, all that kind of stuff. And so the lending standards are as strict as they've ever been in that. So we just don't have a lot of buyers that, went in there and couldn't afford their stuff unless something major happened. Right. We made sure that they could afford the house, which is way different than before '08. Obviously with the inventory piece and in terms of actual equity in the home. I know John can talk about those two pieces. That part's a lot different 2022 versus '08 of what people had. So that makes it a lot different too.
Yeah. And one of the things that I thought was interesting during what turned out to be the housing crash of 08 to 12, whatever some people say 07, some people say 06. Is that I had, and this was the first person that I ever had that had gotten foreclosed on. And hindsight being what it is, 2020, the lender that I was using at the time was not a super honest guy. We'll just say that.
Okay.
And this particular client closed on their home the day after they quit their job and bought a new car.
Nice.
Okay.
And somehow still qualified for a mortgage.
Sure.
Right. 6 months later, the police were escorting him out of the house because he never made a mortgage payment.
Oh,
but stuff like that where didn't have a job, had no verifiable income, his debt to income ratio went way up because he just bought a car. And still was able to close on a home. Right. So, looking back, I look at all that and go, oh my gosh, how the heck did nobody see this coming? Right. And, you watch movies like The Big Short and stuff like that. And you'll see that some people actually did see it coming and made a ton of money because they saw it coming. And, that was the pendulum swung way over this way.
Right.
And then, come back to like 2017, 2018, and the pendulum was way over here.
Right.
Now we're kind of moderating that a little bit. It's a little bit easier maybe to get a mortgage than it was a couple of years ago.
Right.
And now all of a sudden we have the interest rate hike. Right. So I was kind of thinking about it earlier today as we put a new house on the market. And I used to joke that I was single-handedly solving the inventory crisis because I was putting all these houses on the market. Now I'm single-handedly, contributing to the inventory crisis because now there's so many homes on the market, right? So you just can't win if you're primarily a listing agent. But no, the thing that I do love is that I do have that hindsight and I do have that experience that I've come through that. So the shift that we're going through right now doesn't really scare me at all.
Right. People have a lot more equity now too.
You
guys notice that when you go on listing appointments, right?
Yeah.
If they can't afford or don't want to make that payment or they want to downsize, hey, the good news is you're going to walk away with a pretty good sized number.
Yeah. And we kind of talked about that on the last episode too, that, we used to tell people you need to be in a house minimum of 2 to 3 years before you can think about selling and even breaking even to get out of it. So if you're not planning to be there for that long, and, as recently as last year, people were in their house as little as 3 or 4 months. And if they had to move, they could probably still sell and break even or maybe even make a couple dollars.
Here's a $50,000 check.
Right.
That's so cool.
Crazy.
Yeah. So I think the fastest one that we had one turnaround in 6 months and he was still able to get out and put some money in his pocket.
Goodness gracious.
And just, life circumstances changed. He moved into this condo, got, I think relocated for a job or something. And 6 months later, he's like, hey, I got to put it on the market. So we sold it for him and he made money and, basically got to live there for free for 6 months.
That's crazy.
So
that's why I say we're blessed with the equity piece. I think I shot a video on it recently talking about home equity, how it's such a big equalizer for people in terms of savings because the average American just doesn't have any savings. So the equity piece can be tremendous. We see people that walk away with, 10 months of their salary just by making a house payment.
Right.
I think I saw a stat that in the state of Washington, the average homeowner, like in the Q4 of 2022, walked away with 6 figures, just like it was like 114,000 or something like that of equity just in that quarter. So it's, such a big difference for people to have that piece. And that's definitely a piece that was not prevalent in '08 as the foreclosures and the short sales became second nature for us.
Well, and I think the biggest thing too was we had a lot of interest only loans.
Uh-huh.
So people were just basically renting the house, counting on that appreciation. And when appreciation stopped, that's where people really got hosed, because, I'll even, we were on an interest only 5-1 ARM on our first, and fully amortized second mortgage. So I was the smart one. I put 5% down on our house, because of course house prices are never going to fall more than 5%. So we're going to be fine.
Yep.
So we bought our house for $400,000, did an 85-15-5.
Nice.
So, or 80-15-5. There we go.
Yep.
Math is my strong suit. So 80% on the first, which was interest only at 5.5%.
Yep.
And then the second was 7.5%, fully amortized over 30 years, but balloon payment due in 15.
Okay.
And so we paid very little down on our mortgage because it was mostly interest only.
Yeah.
So when the housing market crashed, when I looked up in 2012, we're still in our house, and we paid $400 for it, and it was worth $275.
Right.
And we owed $400 on
Right.
it. Right. So that's where people got hosed, is if they had to move during that time.
That's the key, right?
Right. That's the thing. Is if you had to move during that time, you had to do a short sale, or you had to go through foreclosure, hose your credit, that sort of thing. Right. Now we're not seeing that as much, because everybody that's getting a mortgage now, really interest-only mortgages don't exist anymore. So they're at least paying something towards principal every month. They've come in with some sort of a down payment, even if it was down payment assistance, or they did a VA loan, zero down. And for the most part, if they're there for, probably at this point, they're going to have to be there again now. If somebody's buying today, probably going to have to be there a year or two before they can sell and break even.
That's not crazy, I guess.
It's not horrible. I mean, honestly, if you're not planning on being in a house for more than a year, maybe you should be the one that rents.
Absolutely.
Right.
That's the conversation we have quite a bit. We're super truthful about that. They're like, hey, when does it not make sense? Well, I'll tell you, just like John said, right off the bat, like if you're there a year less, somewhere around that range, your rent is probably going to be cheaper than what the interest rate and what your payment's going to be on the house. So you're right. In that case, probably not best to buy, but if you're going to be there longer term, which most people are, I think I saw a stat that the average homeowner now is in their home for 9 years. So at that point, you can go through all kinds of little corrections here and there and things like that. But most cases, you're going to be sitting on a bunch of equity at that point. So that's the great part. But you're right. We have that conversation of when does it not make sense? And that's definitely one of the times.
Right.
It doesn't make sense to buy right now.
Yeah. Especially Uncle Sam with his excise tax out here.
Well, yeah. I mean, that's Uncle Jay.
Yeah.
That's Uncle Jay. So, and that's always kind of a shock to people that are from out of state that don't have an excise tax. And all of a sudden there's 1.78% in selling expenses for somebody when they're selling their home. They're like, why is that a seller charge? Talk to Jay Inslee. He can let you know. But
that is a good question. And and talk to your CPA about how you get out of it.
Right.
Look at that question a lot too. I'm sure you guys get it a ton.
Yeah.
Like, how do we get away from excise tax? You can't. How do we get away from capital gains? Talk to your CPA.
Yeah. Well, that's, I think that's more what you're alluding to, is maybe capital gains tax. Because if you are in that house less than 2 years, you will be subject to capital gains tax unless you have, a military exemption because you got, transferred or something like that. And we're not tax advisors, so please do talk to your CPA about that.
Yes. Yeah. There's loopholes, right?
So I'm not sure what this question is.
Let's see.
It says, do you offer mortgage points?
So I'm guessing that they're talking about buying down. So people call it discount points, buy down, lots of interchangeable terms. So yes, short answer is yes. If that's what they're talking about, if they're referring to points or buying down the interest rate. A lot of times it doesn't make a ton of sense to do it right now. So part of what we do is when we get ready to lock, we'll break it down for people. We'll say, hey, here's 4 different rates. Choose 20, choose 4. What does it matter? So we can break down and show you, okay, here's what the cost is in some cases, or lack thereof. Some rates don't have a cost. Here's the payment difference. So we can actually show you how many months of paying for that lower rate it would take to recoup.
Right.
So a lot of times, just looking over simply to that chart, you'll see it'll be like, 20 months to break even. Okay, we'll be there 20 months. And then it'll get down 108 months. You're like, yeah, I'm probably not going to be in this house for 9 years. So it doesn't make sense to do it. And also, since we think, obviously we don't know for 100%, we think that rates will come back down. It probably doesn't make a lot of sense to spend a lot of points right now.
Right.
When you can have the possibility, hopefully, to refinance in 6, 12, 18 months
Right.
or whenever that happens.
And then some people just kind of want that guarantee that, hey, I'd rather just have the lower rate and the lower payment right now. And
Right.
that's why you talk to folks like us, right? Is to just kind of get through that conversation and see what really makes sense for them.
Absolutely.
So like our buyer, it took a little bit of talking around and why this is a good idea, and showing him some charts and graphs and where that makes sense for him to really finally have it sink in that, okay, yes, this does make sense. And in that case, we ended up raising the price of the home a little bit to cover those points, and the seller technically paid them.
Right.
So,
And that's where temporary buy downs, right? We dust off the old standby of temporary
Right.
buy downs come into play. We've done that a ton recently.
Yeah.
Where people are like, hey, we got this extra money from the sellers going to contribute. What do we do with it? Well, here's this cool option that, in this case, if you're at 5.5%, we'll say on your mortgage, the first year could be 3.5%, second year 4.5%, and then years 3 through 30 is 5.5%. But the good news is two things. One is you might not ever see 5.5%. It's possible that next year the experts could be right and we could be in the 4s. So again, you can refinance, save some money, move on to there if it makes sense, obviously. Second is we actually take that money and hold it in an escrow account. So if it's $10,000 to buy down the rate, those 2 ways, we call it a 2-1 buy down. That $10,000 gets put into an escrow account that if you ever did refinance before that, that money comes back to you. And so it's not just a cost that's like, oh, sorry, we lost the 10 grand from the seller because you refinanced after 18 months. Like the money's still there. So some portion of it. So that's a cool part that we've been talking about a lot. Again, it's not a movement thing. Everybody has it. It's not a new thing. I didn't come up with it. It's been around for a long time, but it makes sense in environments like now where we've suddenly shifted and sellers say, hey, how can we entice someone to look at our house, right? Houses aren't moving in 17 minutes. They're maybe, 17 days. So this is another option we can print out to people. We've had somebody that was like, hey, husband, wife is graduating from college in a year. She's going to have a great job at that point, but things are a little bit tighter right now. Hey, they can get into the house with this cool program, have a much lower payment, at least the first couple of years. And then at that point, it won't matter as much. We still qualified them, obviously, based on they qualify, but it gives them some breathing room with that first payment. The first year, I think, was like $600 or $700 lower a month. Second one was like $300 to $350. So it gives them some serious breathing room to say, okay, wife, you go figure out the college thing. I got the kids. I got my job. Like, it's a pretty cool scenario to at least talk about.
For sure.
Just something different
for
sellers and buyers.
Yeah, every buyer I've worked with in the last, I want to say 2-3 months now, we've all had something getting paid for. Whether it's an interest rate, it's your closing cost, whatever. Like, that does make it super incentivizing.
Right. And people don't realize how different that is from, I say 6 months ago. I don't know if it's even shorter than that. But it was like, A, what are you waiving? Are you getting rid of inspections? Are you getting rid of everything? B, how much are you paying over the list price? That's cute. You want a discount, not happening.
Right.
C, how much are you going to cover on our 22 AD form that says if appraisal's short, you're going to cough up X amount.
Right.
You guys remember those.
We're paying extra.
Oh, yeah.
Yeah, it was
Extra on top of extra.
extra on top of extra. Don't you dare ask for an inspection.
Right.
Yeah, I doubt Dave and Karen are on here, but if they are on here, we sold their house for $205,000 above list price.
Broke sales
Earlier
record.
this year, set a new sales record in their neighborhood, even higher than the preferred realtor in the neighborhood. So we're good with that. But
That's shocking.
the buyer's agent had the buyer waive their financing contingency, waive their inspection contingency, put, I don't know, it was $70,000 or $80,000 on a low appraisal addendum. Basically just saying it doesn't matter what the appraisal comes in at, we're going to pay it. And they had to scramble. They had to come up with like an extra $200,000 at the end because they didn't think, number one, that their escalator would go all the way up to 1.1 million, which it did.
Right.
And that the appraisal would come in low, which it did. So
Gosh.
At the end of the day, the worst thing that would have happened is they wouldn't have been able to close, and my sellers would have gotten a $70,000 thanks for taking your house off the market for 3 weeks check.
Yeah.
So,
that's
that's
worth roll the
insane.
dice.
Well, I mean, you got that offer, day 2?
Well, I had one offer that was at like $950 with an
And what'd you list
escalator. We listed it at 895.
Okay.
Yeah.
So we had an offer at 950 with an escalator up to 1.1 million, but we had to have one that beat 950 to get that
Push
to
it.
come up above it.
Because you have to prove it, right?
Right.
The escalation clause, you have to say, here's the actual. Got it.
So we kept getting offers, like 950, 960, 925, 950. And I'm like, man. And the other guy in the neighborhood had sold the house for $1,025,000.
Okay.
And I'm like, I just want $1,026,000. That's all I want.
Right.
Right. I just want to beat that guy. That's all I want. And so literally like 2 hours before we're reviewing offers, another offer comes in at like 975 with an escalator up to 1.1, waiving everything. So that brought the escalator up to 1.1. And I just called him and I said, look, we have two that have escalated to 1.1. You've waived everything. They haven't. We'd like to go with your offer. I just want to make sure that you're good at 1.1. He's like,
Right.
We're good. So we signed it around.
And how long ago was that?
That was
time
in
wise?
March
Of this year?
Yeah.
Yep.
See, not even 6 months ago.
Yeah.
Yep. No, yeah.
And now all of a sudden we're like stuff sits for a little bit longer. We're getting
Oh, yeah.
Yep.
seller paid closing costs. We're getting inspections are getting done. Contingent offers getting done.
Yep.
It's crazy.
Yep.
Things change.
Yeah. On that one, I was literally on the golf course playing golf with my parents in California, like responding to people that are sending offers because we had to review that night. I'm like, just give me one that's going to get me to that 1.1 million.
Typical
Boom.
realtor playing
You know,
golf.
I know,
Yeah,
right?
Life is so tough.
Yeah. Yeah.
Jesse's
All
looking
these
at-
offers.
right?
I'm just trying to work on my 7-iron.
Yeah. Yeah. No, I can hit my 7-iron good. It's my driver that I suck
That's
at.
the
But
driver. I'm sure a lot of people struggle with that.
I did take a picture. This was probably about 10 or 15 years ago. I pulled into the parking lot and there was like a BMW, a Mercedes, Bentley, Range Rover, all like lined up. And so I take a picture of this and I'm like, I don't know why people think realtors make a lot of money. So
They're all
Yeah,
leased.
they-
That's the secret.
that's the thing is
exactly.
like none of those people actually had money. They had really big car payments.
Right? It's a tax write-off.
So yeah. Good Dave Ramsey boy. I haven't had a car payment in like 5 years. So
Dude, nice job on that.
um,
I can't say the same thing at all.
So, all right. Well, here's a big question: is it a good time to buy now, or should we wait till rates come down?
So I think this goes back to what we were literally just talking about. Like that was part of what was driving that. If you get rates in 2s, 3s, and 4s, a lot more people will want to and can afford to buy at that point. And I think it goes back from all the stuff we're talking about right this second.
Mm-hmm.
Contingent offers, inspections, discounts on prices, like those things I think go to the wayside pretty quickly. And experts are definitely saying that rates will drop, but I think it goes into it. I felt so sorry for you guys and all your agents. Like I have saying, I don't know how many houses a family can fall in love with and still write an offer.
Right.
Like you're on the 8th house that you've written an offer on. Can you still love that
Yeah.
house?
Yeah.
And so now you have a little bit more time. So I think that is it a good time? Again, question we get all the time, and I'm sure you guys do too. I think that's such a specific question to what people have.
It's up
going
to
on in their
you.
life.
Can you buy right now?
Absolutely.
Like people, I wish I would have bought in 2008. Well, could you? Oh,
Yeah.
wait, no.
Yeah.
So
Yeah,
then it
not
wasn't
so
a good
much.
time.
Yeah.
Or I wish I could have bought when we were in the 2s, right?
Right.
Yeah. So
could you?
yeah, exactly. We can't
No.
we can't go back in time. I wish
Yeah.
we could. We'd all have all kinds of stuff, right?
Right.
I told my parents to buy Microsoft early on.
Bitcoin.
We'd
What's
have a
that?
whole different conversation. Yeah, Bitcoin, exactly. So I think that's where a consultation with you, me,
Right.
some combination thereof, with people can start asking questions and start giving them stuff. I think that's where it goes a long ways to try to figure out if that makes sense to people. Because there's a lot of times, like I said, we definitely talk to people and say, hey, it sounds like that we're not there yet, right? It's not
Right.
a good situation for you yet. We'd love to earn your business in the future. Just stay in touch.
Yep.
A lot of times it's pretty easy for people to just shoot a text or a phone call and say, how are things looking? Like for us, especially, we save everything in our system.
Mhm.
It's easy for me to hop back in and say, hey, what changed or what are we looking at? Okay, here's kind of where we're at now. Is that better? Call John, call Jordan. If that price range works better for you now, go forward. If it doesn't,
Yeah.
like we'll be here. But again, every market, no matter what it is, seems to have goods and bads for everybody. So it's such a specific question to people. We love to take some time and just slow that question down.
Yeah.
And say, let's talk about that piece.
Well, and
question.
I think at the end of the day too, really what we're telling them is it really depends on what your goals are, right?
Mhm.
Right. So if if you think it's a good time to buy for you right now, then you should absolutely do that. If you think you should wait, then you should absolutely do that. And let us give you the information
Right.
to help you make that decision.
Yep.
Right. Because like you were talking about, Steven, that, right now you can get an inspection on a house. You
Right.
can get the seller to pay some fees for you, and you're going to pay a higher interest rate
Right.
for that. Right.
Yep.
So maybe it's better to lock in the house that you love right now, because you have a choice of homes.
Right.
You don't have to pick the first one that you see.
Right.
You can take your time, make the decision for the house that actually fits for you and your family. And yeah, maybe you're paying a little bit more than you wanted to for that house in terms of a monthly payment because of that interest rate.
Right.
And should mortgage rates drop down, you have the option to refi and bring that payment down. So now you're in the house that you love and a payment that you love.
Right.
And it doesn't get better than that. Whereas if people are going to wait, home prices are going to still continue to rise.
Yes.
So kind of like I mentioned last time, we're in this messy in the middle where we priced on this line. We should have been on this line. We're figuring out that line right now. We just dropped the price on one of our listings today by $10,000.
Right.
Once we figure that out, home prices will continue to go up. We're expecting, 3 to 5% next year. Home prices will go up. So if all of a sudden interest rates come back down into the low fives or the, mid fours, that's going to bring a lot more buyers back out of the woodwork.
Right.
And so you're going to be in those competitions and
Right.
maybe, multiple offers, not getting an inspection, not getting the seller to pay some of your costs. So what did you really gain? You're paying more for a house, but you got a lower interest rate, and maybe you're not in the house that's perfect.
Yeah.
So
Great question.
somebody asked, how much does a refi cost? Since we're talking about, maybe you get in now and you have to refi, 2-3 years down the road when those rates come down.
Yeah. So very specific question again. I could give kind of a broad range on that. And I would say actual cost, you're probably, we'll say 2 percentage points. So 400,000
Of the loan amount.
Yeah, you're probably $6,000 to $8,000 if I had to guess.
Right.
There are a lot of unique programs that have less cost. There are some people that go in there and say, okay, this is my forever house. Rates are as low as I think they're going to be. Let's refinance. Let's pull cash out. So that varies a ton. The good news is that if we get to that point, and when we get to that point, we are huge on giving that information up front. So if you're a past client of ours, it's super easy for us to hop in there and say, okay, hypothetically, your home's worth this. I can tell exactly what you owe on the house if you haven't made extra payments. The new rate would be this. Here's the payment. So we will reach out to clients and say, hey, it's going to cost you X amount of dollars. You're going to save X amount of dollars. With that savings, you can recoup your cost in X amount of months. This makes sense. Or in some cases, nope, doesn't make sense yet. We're going to keep an eye on it. That's part of what we do. There's a lot of times, a lot of online lenders or .com lenders that will be like pushing it. Hey, we're not going to give you anything until we pull credit and you give me all these documents and you wait 2 weeks. We're huge about being transparent, very close up front. If it doesn't make sense, if you're going to save $58 a month, it's going to cost you 10 grand.
Right.
Yes, I can do it. No, we're not doing it.
Right.
Unless you force me to. I can't tell you no.
Right.
But I'm going to tell you all the reasons why you shouldn't.
Yeah.
That's the stuff that's scary when you see people and you hear the stories of people going through this long process of, someone just sitting on the other end of a phone that doesn't care about what you do. They just want to get that refinance.
Sure.
So like I said, that ranges a ton, very specific. But like I said, we're huge about being transparent about the savings and the cost up front before we go through all the mess of going through stuff.
Right.
So.
And I had a person reach out to me for information about selling their home. They're in a community called Grand Firs here out in Graham.
Yep.
Like back in 2007, it was advertised as the last of the big lots, right? They're all, third to half acre lots. And she reaches out and says, hey, we need to sell our house. Okay, what do you owe on it? So I kind of figured, I'm like, I think we're probably about $10,000, $15,000 away from just being able to get you out of it and break even. So let's give it 6 months and we'll look at it again. So I call her in 6 months and I say, hey, good news. I think prices are where we need them to be to get you out of that house. When can we meet? And she's like, well, we refied. So I look it up. They now owe $10,000 more than they did 6 months ago on the house. I'm like, okay, well, don't do that again. Let's wait another 6 months, see what happens. what do you think happened? I called her again in 6 months.
No.
Rates went down.
Again.
We refied again. So, okay. Well, like this happened 3 times.
Yeah.
They're still in that house. This has been 3 years. Right. And now I think we could probably get them out. And I think that they finally figured out that they should stop refining, and probably rates going up help that.
Right.
Yeah, exactly.
Right?
Now you
So,
can't, or you shouldn't.
Yeah. Yeah.
Yeah, absolutely. So that, ranges a ton. There are like FHA and VA programs that are very much reduced cost that can save you a ton. And there's safeguards in place for those guys. So for FHA and VA, there's safeguards of refinance. Says, hey, you can't do it too often. You have to have bona fide savings.
Right.
You have to have limits on cost, but for conventional, it doesn't have that.
Yeah.
So that's where we see a lot of people get preyed upon, that there's massive cost, there's very little savings, but they sell it in such a way that people are like, oh, stars in the eyes. And you're like,
You're going to save
darn it.
$300 a month. It's
Yep.
only going to cost you $20,000.
Yeah. You're like, oh,
But we're not taking that out of your pocket. We're just going to add that
we're
onto
just
your
gonna add
mortgage.
it in there. You're going to live there
Yeah.
5 years, right? No, we're leaving here in 12 months.
Yeah.
Oh, that's fine.
Yeah.
You're gonna skip a month's payment.
Yeah,
So
there you
you're
go. Yeah. Yeah.
That's a great
Um,
question, though.
Well,
All right.
going off of that,
Yeah.
refinances and all that, and like we were talking about, so much equity and everything, and even better option for a lot of people right now might be HELOCs. You know, going. That's
Oh my gosh.
Home equity line
All
of
the
credit.
time. Probably once a day.
Yeah.
We get a phone call, text, email. How do we do this? How do we do it?
It's all over the news now. People are catching on. They're like, hold on.
Yeah.
I
And it's
got
something that a lot of
money.
people haven't had for a long time.
Yeah.
So there was a time when people didn't have equity. They were upside down, but you're only upside down truly if you sell the house, right?
Right.
So home equity line basically works like a credit card.
Hmm.
It goes in second lien position, which means that if your house sells, we pay off the first mortgage first. That one goes behind it. So they will allow you to basically have a line of credit for part of your equity. They'll never go to the full amount. You can't tap all of
Mhm.
it yet. There probably are some people that will come back and do that. But a lot of times it can be a great inexpensive way to have this credit card. In some cases, you actually get a credit card sitting there that if you need to access it, if there's an emergency, better yet, if there's an investment opportunity and you want to use some short-term money, you can borrow it from this line of credit, pay it back, borrow it, pay it back,
Mhm.
use it just like a credit card. And it's very inexpensive money for the most part. It's cheaper than a credit card. It's obviously gone up. As we see the Fed raising rates, that's what gets affected. It's not mortgage
Right.
rates necessarily. It's HELOCs, but HELOCs are a great way. Like I said, we get a call at least once a day. What is this? What does it look like? The good news is it's super low cost.
Mhm.
If you're not using it, it's pretty much no cost. And it's a great way to kind of have it there for emergencies, for all kinds of different uses. You can use it for whatever the heck you want.
Right.
And like I said, you can use it and pay it off for at least the first 10 years. So it's a cool program because a lot of people are sitting on the equity right now. So
Yeah, and you know the thing that I got myself in trouble with is when I bought my first house before I was a real estate agent, and I didn't really understand any of this.
Right.
I would run up credit cards, I'd buy a new car or whatever, and then my mortgage guy would conveniently call me and say, "Hey, by the way, John, you've got about $40,000 worth of equity in your house. We could refinance, get you a cash out refi, pay off some bills if you wanted to do that." Okay. So, you know, I bought my
Check.
first house for $90,000 in '96.
Yeah.
On a 3% FHA loan.
love it.
And my dad's gift funds were immediately due upon closing. So by the time I sold that in 2006, I owed $200,000 on that house. Now I did fix it up. I put in new carpet and paint and a new roof and air conditioning. And it was a much nicer house when I sold it,
Right.
but I also paid off a lot of credit cards and cars and motorcycles and trailers and
Mhm.
things like that with it too. So I wouldn't be a good Dave Ramsey person if I didn't
Yes.
tell people
Right.
don't use the equity in your house like an ATM.
Yes.
You can use it for, honestly, you can use it for whatever you want to, but I would tell you don't use it like an ATM. Don't use it like a credit card.
Right.
My wife and I took out a home equity line of credit right as COVID was ramping up, and we paid cash for a house out in Chicago that's now a rental. We'll kind of, on one of the future episodes, we'll kind of go through that deal and how that all worked out.
Yeah.
But basically, we were able to buy a rental house for $70,000 cash, and through that process, we ended up with only about $4,000 out of our pocket.
Right.
That now cash flows, $600 a month.
Yeah, that's the investment part that I'm talking about.
And now I've still got that home equity line of credit that I can go do that again and do it
Right.
again and do it again.
Right.
Right. And now all of a sudden I've got $4,000 or $5,000 a month in cash flow coming in,
Right.
really with not much money out of my pocket.
Right. That's what people don't realize. I think a lot of times is that you can use that in those cases. Those are your funds. It's secured funds. So you can use that as a down payment. So a lot of times people can buy the move up house and not go contingent. They can buy a rental house, like you said, without doing that. So yeah, don't necessarily use that. Don't take it to El Gaucho and
Right.
buy all your friends dinner, but definitely have it there for, like I said, emergencies. We've seen people, hey, I got to spend 10 grand to fix a roof or something like
Right.
that. Great. Use it. It's already there. Or like you said, even better than that, for an investment opportunity. They got this cool
Woodford Baccarat
duplex.
would qualify though,
Woodford
right?
Baccarat would absolutely
Okay. All right.
qualify
So
for that.
we can make that happen.
Right. Because I heard that is not only a beautiful, beautiful bottle, obviously because it's Baccarat, but
Right.
I heard the juice is pretty special
Yeah.
inside too. So
Yeah. So
excited to try that one of these days.
very cool. Yeah. I did see it on a menu, and it was $150 a shot.
Where'd you see that at?
I think it was at Gaucho. I think it might have been at Gaucho.
Just a quick
Mm.
150. Why not?
Yeah.
It's got a HELOC.
Yeah.
Yeah, right,
There you
right,
go.
there you
Yeah.
go. That's good use.
Yeah.
Rare bourbon. I love it.
All right. So let's see. Another big question. This might be too big.
Uh-oh.
Oh,
Are we in a bubble?
I think that's more you guys thing.
Bah.
Yeah,
It's over.
it's over.
No,
No, I don't think so.
fortunately.
I think we definitely have the graphs and charts and stuff to do that. I don't think we have a bubble. We don't have the inventory issue. We don't have the lack of equity issue. We have people that can, like I said, for the most part, afford their houses.
Yeah.
Unless something major happens. So yeah, I don't
I think we still have a lot of buyers. I think we still have a lot more buyers for homes than we have homes.
absolutely.
The challenge right now is just that a lot of those buyers are sitting on the sidelines
Yes.
waiting for something to happen.
Right.
Right. So either they're waiting to talk to somebody like us that can explain why it might still be a good idea to buy right now, even with higher interest rates, or they're waiting for those interest rates to come down.
Right.
They're still there. They still want to buy.
Mm-hmm.
And so any inventory that we're gaining right now, once those interest rates come down and people get more comfortable with seeing those numbers.
Right.
I mean, really for 10 years, we haven't seen the numbers that we're at now.
Right.
Right. So yeah, I don't think it's a bubble.
Well,
That's a good question.
It goes back to like what we said in the beginning. Like if you're not in this and going at it the whole time, if you're just watching the news, it's like it
Mhm.
looks like the whole world's falling apart.
Right.
It's
Yeah.
like it's over. You lost all your money. You lost your chance. Get out of here.
Right. Yeah, we do have one vote from Steve Bargelt for Woodford Baccarat.
Okay.
So
Doing it. Steve is paying, and we
So
are
Steve will
sampling.
Yeah, we're
be
using
reaching
his
out
house,
shortly.
or-
You did his mortgage, so you can do his HELOC. And,
Yep.
and
HELOC.
he'll be having us over for Woodford Baccarat. here
Woodford
shortly.
Baccarat HELOC. I like that.
Yes,
That's a
perfect.
good plan.
All right, so we kind of talked about this a little bit yesterday. You kind of popped in, and we were talking about what we were going to talk about. What are portfolio loans?
Big presence. I actually was on a conference call a little earlier about a possible new portfolio loan. Basically, when rates are 2-3%, private money's like, hey, there's not much money to be made there. Now, as rates climb up, as we get a little bit, different options, private money comes back. We've seen it a lot. People call it non-QM, which is qualified mortgage, is basically the normal box.
Mhm.
FHA, VA, conventional fit into a qualified mortgage. Outside of that, we call it non-QM, or we call it portfolio, we call it private money. And it's basically groups of people that come together and say, hey, we have our own money. We can write our own rules about lending and give these unique products. So bank statement loans, something we've done quite a bit. Self-employed borrowers, stop me if you've ever heard this before, make some good money, don't want to show a big tax
Right.
liability, so the bottom line doesn't look as good for the bank. So private money says, okay, that person still is a great person to get a house, right? They have a high credit score, they have money in the bank, they can afford all their debts. Let's give a program that we can basically look at 12 months of bank statements. Let's take their deposits, add those up, give them credit for 50% of that to use as income. That's now your income. So we don't look at tax returns, look at pay stubs or profit and losses. It's just about this. If we can see that money is coming in, we look at all the rest of the stuff. We know the credit score is good and things like that. Let's do that loan. So that's a loan that we do quite a bit now. That's
So we
again,
call this
private money.
Colombian drug lord.
Yeah.
loan. Oh wait, but they don't put their money in banks.
They
so
don't.
That's not
Yeah.
gonna
And you will have to source these things. You
Right.
can't just, If you have $100,000 deposit, they're going to be like, okay, you need an invoice, give
That's
me
a
a
really good
commission
day.
slip, give me something.
Yeah.
Yeah. If hopefully you sold a $1.1
What
million dollar
what
house.
is Cocoa Bean Enterprises?
So yeah, stuff like that. So it's the one-off stuff. It's the, hey, you don't fit in the conventional FHA VA box, but we have this private money that will do that. So that has made a big comeback. We see a lot of different stuff. We're not back to the crazy stuff from 2006 and 5 with the, stated income yet. It may come back at some point, maybe not as loosey-goosey as it was back then, but we definitely see a lot more outside the box type stuff. So if you are self-employed, if you have a unique scenario, reach out. There's a lot of times that we say, hey, we have an option for you, or that's pretty unique. I haven't heard of that. We don't hear that very often, but there's a lot of times that people that have been told no because they don't fit inside the normal box, there are programs that are here or coming down the road that can help those guys achieve homeownership or buy more investment properties.
Right.
We have some pretty cool investment stuff, again, that doesn't look at any tax returns, and it looks at, does the property cash flow? Are you going to put a big chunk of money down? Credit score good? You can buy an investment property.
Right.
And we don't care how many investment properties you buy.
And when you say private money, is that just like Jeff Bezos is like?
It could be. Yeah. In some cases, it could be hedge funds.
Huh.
We've seen banks do off the cuff type stuff. We've seen local private people that just pool their money up, and they basically have like a little committee. They're like, hey, throw us the goods and bads of what's going on. We're going to grab 5, 6 of us that, are in charge of this stack of money. And we're going to say, yep, let's loan that out. So that's really, it's kind of a broad term, but yeah, there's definitely some unique programs here and more unique programs coming that can help people that are not able to buy with conventional type stuff. Yeah. Great question.
Yeah. I know a few realtors that actually are in the private money space too. So
Oh, nice.
they lend their money out. Yeah. I mean, you're not going to like the terms, right?
Right.
And it works for some people, like people that are flipping houses that really need access to a lot of short-term money.
Yep.
There's a lot of business cases for it. A lot of guys that are developing property right now to turn into developments don't necessarily want to go through the process of going through a bank and will pay higher fees to borrow the money to develop that land. So there's a lot of use case. One of my coaches, Brett Tanner, does a whole seminar on private money lending, and he was doing so much of it in Arizona that he had to get a banking license.
Oh wow!
The state of Arizona came to him and said, "Hey, buddy, like we've been noticing your name on a bunch of private notes, and it's to the level now where you actually need to get a banker's license."
Good for him.
That's a flex.
So, yeah,
yeah, that's probably expensive and lots of rigmarole, but good for him. That means he's doing a lot.
Honey, I am the bank.
right.
Yeah, absolutely.
Well, and then so you threw out FHA, VA, conventional. A lot of people may not know what those programs actually are. So I know that we could go way down into the weeds on what every one of those things are, but just a quick synopsis of what the FHA, VA, conventional.
So super quick synopsis. FHA is backed by the federal government. They don't lend the money, but they get to write the rules. There's basically security by using that type of loan. Typically, that's going to be more inclusive for most people. It's going to have a larger range of credit scores. It's going to have the ability to buy owner-occupied, typically with less down, with down payment assistance. So FHA is we do a lot of FHA loans. Fantastic loan program. There are drawbacks to it with mortgage insurance for life. So that's different than other programs. But like I said, very inclusive. So if you're a lower credit score, it's going to behoove you typically financially to go FHA versus conventional. VA is for our amazing veterans. It's for some types of spouses of people that have passed away. But amazing program. Typically gives you the ability to have multiple VA loans, which most people call me and they're like, I already have one. I'm like, you can have more than one. Typically allows you to go 100% financing, so no down payment. There's no mortgage insurance. There's all kinds of great stuff. We love VA. Again, there are some drawbacks to that. There's drawbacks sometimes if you're going multiple offers and a listing agent has had some bad stuff happen with VA. So again, easy for us to talk about goods and bads. And then conventional is probably the most exclusive in terms of all the types of things that it does, but it's very much a lot more inclusive when it comes to credit score. So if you have large down payments, if you have super high credit scores, conventional typically is going to be your go-to. Conventional also is the only one that will do second homes or investment properties. So vacation house or houses you're never going to live in. FHA and VA don't do that. But the good news is that when we go through it, we talk about what you're approved for program wise. And then it's easy for us to lay it out side by side and say, okay, you qualify for 2 of these programs because you're not a veteran or you are a veteran.
No.
Here's the good, bad, and ugly of both.
Right.
And it's easy for us to, you're not stuck one way. Once you get pre-approved, a lot of people think that they're stuck with,
Right.
Whatever we qualified them for or whatever program. Like, no, it's not like that. Like it's a couple of mouse clicks for us to change this program. I'll tell you the good and bad about going that way. We'll talk about your guys' agent in terms of your offer and what else is going on there. But yeah, that's kind of the broad synopsis of those 3 guys.
Okay.
And then USDA, again, is rural lending. So they're trying to incentivize middle to lower income people to buy in rural areas. So 100% financing. It's probably, as weird as this sounds, one of the more strict or rigorous programs when it comes to credit score and debt to income.
Oh, really?
So I don't know if that's really because it's low to moderate income. They want to make sure that these people, are stuck put in a house that they can really truly afford, because they look at all kinds of stuff for qualification purposes. But amazing product, especially like in our area. We have tons of area out that direction that all qualify for USDA.
Mhm.
So
Right.
pretty cool program to talk about. And like I said, most people have no idea that it even exists.
Yeah. Speaking of like VA, you mentioned that some agents are a little hesitant to
Mhm.
accept VA. There's this myth out there about VA loans where the appraisers are a lot more strict, and like help us like allay some of those agents' fears.
Or even, they have no money. That's why they're using VA.
Yeah,
Right.
skin in the game.
Yep.
We hear that quite a bit. So yeah, there's that. We actually teach a class about it called VA myth busting, which is not only for agents, but it's a lot for buyers too. Because there's a lot of misnomers about that people have heard of, or they've read somewhere on the Google machine that about VA, and there's a lot of misinformation out there. So in terms of listing agents, there's absolutely a time that was before my time of 08 where VA was much more strict. It was a much more difficult process to get it done. Now, for the most part, they've aligned their appraisal standards with FHA. So FHA says, hey, if there's peeling paint on the side of that, VA says the same thing.
Right.
You need to scrape that. If it's pre-1976, it could have lead in it. We don't want people choking on it. We don't want people getting sick. So scrape it and do it. So for the most part, people have spent a lot of money for houses right now. So listing agents, come on. Let's
right.
put a little scrape, put a little paint on there. We don't want people choking on stuff. So for the most part, they've aligned with FHA, which again, they are a little bit more strict, right? But for the most part, it's safety and health hazards.
Right.
So a lot of times people think that it's going to be the super strict, here's what it's going to look like. But a lot of times it's like, hey, there's a broken handrail, and as someone walks down 4 steps, let's fix that so people don't fall. Or there's a broken window, someone can put their arm through it, fix that type of stuff. The good news is that a lot of times that only has to be remedied before closing. Or a lot of times we can do what's called an escrow holdback, which means we can pay XYZ glass company with a bill to say, hey, after closing, when the possession changes hand, the buyers have the house, we're going to come out and fix that after the fact. There's rehab programs, there's other ways, there's all kinds of ways to get creative with that type of financing if the house has some needs that need to get done. But typically it's just normal stuff, safety and health that needs to be addressed.
Right.
We get a lot of calls up front when people take listings or they're going to go look at a house and they send us pictures of stuff. Do you think this will get called out?
Right.
Easy for us to vet that. Obviously, each appraiser is completely different. They could go out there and, look at this, or they could look at everything and get super scrutiny. So we can't control that part. We can't, on any appraisal, we have no control over who gets chosen or what they call out. But we have great kind of guidelines that we provide to people, to realtors, and say, hey, here's kind of the hot buttons that we see as a, top 10 large company. We have a lot of VA appraisals or a lot of FHA appraisals. We actually have a chart that breaks it down and said, here's some kind of hot buttons. So that's probably the hardest thing that we hear about. Skin in the game. Another thing, they say, hey, I don't see a down payment for these guys. Does that make them a weak buyer? And we actually have the financials for it. It's crazy. The average VA buyer usually puts some type of money down. They have super high credit scores. Again, we go through extra steps in qualifying that person that we don't with other loan programs.
Right.
We look at what their childcare expenses are. We don't do that for any other program. We take a calculation of square footage of the new house and calculate what the heating, gas, water is going to be. We add that in there and make sure that they still qualify. So VA, we go much, much further where, yes, that person in some cases doesn't have to put a down payment down. But I promise you, the formula that we have to use to make sure they have what's called residual income left over each month, they are a strong buyer.
Right.
And it has one of the lowest default rates too,
It
right?
does, yeah.
Yeah.
Which again, sellers are like, blah, we don't care.
I know.
But at the same point, yeah, it's for a lending standpoint, it's an amazing loan program, and yeah, absolutely the one of the highest default rates. And you can have multiple loans, and you can rent them out. There's all kinds of things.
Default rate, right?
Lowest default rate. Yeah, it's fantastic. Cool program for buyers too.
Yeah. Yeah. I mean, going back to like you said, where you're diligently checking, like I'll be the first to say I probably annoy Steven all the time. I'm like, is this VA approved?
No, give it all the time. Especially with condos.
Yeah.
Especially too, because we don't do a ton of condos here. People will shoot me condos all the time. Does this qualify for FHA or VA conventional? So yeah, that's super easy for us to do. So never feel bad like you're bugging me.
Yeah. And we got another question from the gallery.
Yeah.
And I think we kind of covered this a little bit, but we'll just kind of rehash it again here real quick. What programs do you have for first-time home buyers? What about young couples who have so-so credit ratings?
So again, I think down payment assistance incorporates a lot of those people. Don't have to be a first-time home buyer, but it does, like I said, minimum credit score is 620 or lower, or higher, excuse me. So that a lot of people fit into that. Other than that, like conventional has a 3% down program. So you don't have to put in 5 or 10 or 20% at that point. Other than that, there's not a ton of first-time home buyer programs at that point. I would say DPA is probably the go-to where
down payment
my
assistance.
down payment assistance through Washington State Housing Finance Commission is probably the go-to that I would say to most people to, hey, check this out, or we can obviously give you all tons of information on it that would qualify for not having to be a first-time home buyer. But if you don't have a lot of money for down payment, scores a little bit on the lower side or even on the higher side, the money aspect, right? There's a lot of people that say, hey, I have a great job, I have decent enough credit or better. The one thing I don't have is down payment. That program helps. An absolute ton of people get into it. So make less than 160 grand is a lot of people.
Yeah. Right. And so for whoever sent in that note, for whatever reason, the software that we're using, if you're on Facebook, it doesn't tell us who that is. So whoever had that question, if you want to send me an email to show@altitudehomes.com, I can put you in touch with Steven, and we can kind of run through your particular scenario and just kind of figure out where you're at and what we need to do. Like we say, we never tell you can't buy a house. It just might not be right now.
Right.
So depending on where you're at, we can pull your credit and kind of look at income and see where you're at right now and figure out what program would be best for you guys in your situation. It's really going to be dependent on a lot of different things.
Right. Even the term lower credit is so subjective.
Right.
We have people that, oh, congratulations, your mid score is a 790. What?
Yeah.
What? Like, I'm like, what are you talking about? That's an A plus, like 760 plus. It's always 800. I'm like, are you serious? Okay. I'll show you how to get back to 800. It's gonna be pay your Amex card down $9.78 probably.
There you go.
And you're around 800. But yeah, super subjective on that too. People and they think it sometimes and we'll pull credit and it'll be like a 740 or 728. They're like, I had no idea. I'm like, yeah, a lot of people just don't, because we don't deal with that. We don't pull our credit a lot. We don't realize what's going on. So a lot of times that clarity can be tremendous for people with credit.
Well, and I think, for a long time, I believed that the scale was like 0 to 1,000, right? So when I was at like 650, 660, 700, I'm like, man, I'm like a C, right? Because you think of it but really the scale's up to maybe 850.
Right.
And the other challenge with credit scores is they never really tell you exactly what the rules are.
Yeah.
No.
Right.
Yeah.
So.
Yeah, exactly. We have some little bit of guidance and some parameters to follow, but you're right. It is a complex algorithm that nobody seems to solve. It's pretty archaic.
Yeah, right.
They're always talking about, hey, we're going to revamp it one of these days. They're not. I don't know if they're going to.
Oh, it's fun, right? You're like,
But-
you just paid off your car. I'm taking points away.
Yeah,
Yeah.
exactly. But the good news is that we have, for the most part, like for light lifting, like if we have a little bit of room to do, like we can instantly tell you, hey, do this, this, and this. It's not 100% guaranteed. But if you trust it, if you do it, more than likely it's going to happen. Or if you need to do heavy lifting, like someone's got some pretty low scores, we have some great referral partners that will literally dig in and work on your behalf and say, okay, here's the stuff we're going to do. Here's the time frame. I'm going to check in with you every 30 days. We're going to give updates, like whatever help you need, little tons, anything in between. Like we have the resources to help with that piece.
Yeah.
A lot of people just don't have the time or don't want to have, or don't have the knowledge to be able to allocate to helping that piece. So we got you on that.
Yeah. There's only just just a couple other little questions here. You mentioned rehab loans.
Yep.
Really quickly, what are those?
So rehab loan, again, now that the market has kind of shifted back to this, we have a little more time. These are becoming prevalent. Conventional, FHA, and VA all have rehab loans. So what basically says is that you can actually take the cost of rehabilitation, whether it's needed or not needed, and you can add it to the loan amount. So you can walk into a $350,000 house, and that house could be deficient. It could be, hey, we're missing a roof, or we're missing windows, or it could be a turnkey house where you say, man, if I could only change the flooring, change appliances, add some square footage to this house, this would be the dream house. So anything in between those two and all encompassing, you can add that into the loan. So if you're buying a $400,000 house, you could say, I'm going to take $50,000 of rehab, add it in there. So now you're 400 plus 50, 450. Your down payment's based on the 450. And then the work is done by a licensed, bonded, vetted contractor that you get to choose, and it happens after closing.
Okay.
So closing turn times happens, the work begins, appraiser comes back out there, double checks the work. But again, now that we have a little bit more time, there's not 28 offers on a house necessarily. It gives us time where people can say, hey, here's some stuff that I don't have the money for it, or I don't want to put it on a Home Depot card at 28%. Here's a good way to get it done. Or again, if you have a house that is deficient and won't close without it, and seller's got no money or they don't want to do anything, it's a cool program.
Yeah.
So again, FHA, VA, and conventional all have rehab programs. It's pretty cool.
So they
Super
appraise
cool.
it off of what you're fixing or making better or whatever.
Great question. So they actually value it based on what it's worth now. And then, yes, they actually have a list of the items. So there's a few more steps in the process that we do behind our end, and we can show you. But they basically have the list of stuff too. So the appraiser will say, okay, the house is worth 400 now. You're going to do these things. It's worth 460 afterwards. So there's some ratios in there that we can figure out and try to add some stuff. But you can do, depending on each program, you can do a lot of stuff. Like I said, some cases you can add square footage to the house. You can do ADUs. You can do stuff.
Gold-plated bidets.
Gold-plated bidets. You can hook up to sewer. Wait, septic? Sewer. Right.
Yeah.
You can connect to sewer. We've had people do foundation repairs. And we've had people go in there and just wipe out their entire kitchen and make a really, really pretty kitchen. So it's
And
cool.
again, it's something we could go way down in the weeds on. There's lots
Oh
of
my
different
gosh.
guidelines, and
Yeah.
if it exceeds this amount, then you've got to have this guy watching over it and all that. But
Yeah.
if it's something that you're interested in, you can use it to buy a house, and maybe you're not getting the perfect house, but you have some wiggle room because you're buying well under what you're qualified for, and we can get you the resources that you need to make it the perfect house.
Is that a designation in your guys' MLS? Does it say like financing types? It'll say like
Yeah.
cash or rehab.
Yep.
Yeah.
Yeah. So in
And that's
those
what they
cases-
prefer sometimes on some of those
versus cash.
fixer, or they'll just put cash or rehab.
Yeah.
Right.
A lot of people just aren't scared of that. They're like,
Yeah.
hey, this could be a great house if can get financed in there.
Right.
So
Well,
That's the cool
and the
part about
thing
it.
too is that, when we check those financing types, a lot of agents don't really know whether or not a house would go FHA or VA, so they
Right.
just don't check the box.
Right.
Right. So we always tell people, like, go ahead and look at everything.
Yep.
And then when we actually get out and see it, we can tell you whether or not it's got a good shot at going
Yep.
FHA or VA,
Yeah.
or if we can do a rehab loan to fix some of those things. Like if you walk in and there's a giant hole in the living room, probably going to need a rehab loan.
Yeah.
yes.
Right.
Yep.
But
Just
if
a
you
new
walk
house.
in and it's got, avocado green appliances and, orange shag carpet and things like that, that's still going to go FHA or VA.
Right.
Right. It's just ugly and you want to change it.
Mhm.
Or maybe it's coming back. I don't know.
It all comes back
Bring
around.
back the shag.
Yeah. All right. So we're at an hour and 10 minutes. That was fast.
2 hours. Let's go.
Anything else that you guys want to talk about, or anybody that's still on the live stream? Any other questions that you guys might have?
Did we miss anything? It was like,
I
I think we talked about a lot
Well,
of stuff.
I know you had your one program that you were talking to me about
What's that?
a day or two ago. I think you might have it on there.
Oh,
What?
recasting a loan.
Recasting.
Yeah,
Steven came in on Fireball already,
Yep.
and he just, well, I was like, what's going on?
Popular
Yeah.
thing that people do not know anything about, it seems like.
Yeah.
Yeah.
So with conventional financing, it basically gives you the ability, and obviously check with whomever you're doing your loan with. If it's not us, they can have different rules on this.
Mhm.
But our rule is basically, hey, anytime you want to make a principal payment throughout the life of the loan,
Mhm.
as long as it's $10,000 or more, you can take the money, apply it to the principal, which every loan can do. But typically, when you do that, all it does is shorten up the term.
Right.
It won't change your payment. But in this case, we say, hey, if you pay for a fee, I think it's $300 to $400, we'll actually take the terms of the original loan times the new principal balance, and we'll recalculate the payment for you, which can be huge. So a lot of times, here's a scenario that we do quite a bit. It's like, hey, we found the house we want. There's already an offer. We have this house to sell. We're nowhere close to being able to get it ready to list yet. So, okay, good news is you can qualify with both house payments. So here's a scenario for you. You guys come in here, minimum 5% down, buy the new house, right? Close on that. The good news is you're going to have a little bit of buffer. You're not going to have a payment right away on the house. Now you have the ability to come back to this house, get it ready, sell it, take the time, get your kids moved out, dogs, cats, all that kind of thing. And then once this house sells, you can take the proceeds, which is, like we talked about, everyone's sitting on a boatload of equity, it seems like. Take that money, now apply it over here, and we'll recalculate the payment for you. So in terms of end result payment after that, it's kind of the same thing for the borrower for the most part, right? Because our rule, which I think is the best rule out there, you only have to make one payment here, which a lot of places will be 6 or 12 months, and you can drop mortgage insurance. So you can come in with 5%. Now you can apply $200,000 to it. We'll recalculate the payment for you. And for the most part, other than the fee, it's the same net effect to the buyer, but it gives them the ability to get everything done in a less frantic manner. So yeah, obviously the kicker to that is you're going to have two houses. I can't guarantee your house is going to sell. Jordan can, so that's the good news. But again, it happens all the time. People, I don't know what the option is. We present that option, and it's like, yeah. So it can be a super cool option. Again, FHA and VA don't have that option. Conventional only. But again, it's a win. It can be a win-win for a lot of buyers.
And there's no requirement at any point to recast it. So if for whatever reason your house was the one house that didn't sell,
right,
you could turn around and turn that into a rental.
Absolutely.
And still keep that.
Right. You don't have to. Or you could do it, if you had someone pass down the road and you get a little windfall of money, you could do it again at that point. So for the time being, we don't have any requirement of time period. So yes, you could never do it. You could do it 5 years, 10 years down the road. And as of right now, you can do it multiple times.
Oh, nice.
So you could do it with the selling of this house. If you're getting money over here for some other reason, you could apply it again. So that's a cool way to get it done.
That's super cool. I didn't know you could do more than once. I thought it was like a one-time deal. You got to recast it.
And again, check with every servicer could be different. Right. Movement, we service majority of our loans. It doesn't work for like jumbo type financing and like the non-QM private money we talked about. Usually those programs will not have recast, but if you're doing a normal conventional loan, which is a lot of people right now, it's a cool option for them to get the house that they ultimately want, but have just a lot more breathing room, go non-contingent, like not have to worry about just being in a rush of stuff. Mm-hmm. So cool option to talk about. Doesn't work for everybody, but it's a good thing to have in there that if it does work for that person, it can be a game changer.
For sure. Most important question of the night just came in.
It's from Terry.
What's your favorite color?
Blue.
Whoa.
Yeah.
Jordan?
Oh my God. Oh no.
Really?
Dark red.
Dark red.
That's very specific.
That's very specific.
Yes.
I think you looked at John's shirt when you said that.
Kind of like a wine red. No.
Dried blood. Like a Bordeaux red.
Like a Bordeaux
liquidy
red.
Because of the light hits it.
Yeah.
Okay. John?
Mine's green and purple.
Wimbledon purple.
Wimbledon colors.
Okay.
I had some Nike Air Hirachis back in the 80s that were green and purple, and I loved those shoes.
I've never seen that combo. That's pretty cool, though. They have purple ones right now. I saw the Hirachis. Just came back out. That's a great question. But you can't tell who asked that question, right?
I can't tell who asked that question, but somebody else said, "Where do I get a cool shirt?" I mean, there's lots of places to get cool shirts.
Well, talk to this guy.
No, I think you were talking about the altitude.
Well, I mean, you were a personal shopper at Nordstrom.
That's what I'm saying.
So, I mean, if you want personal shopping advice, Steven's here for you.
Yes, I got you.
I don't know
I get $6 shirts clearance at Kohl's.
The latest shirts that I bought were at Meat Church Barbecue in Texas last week.
Big shout out to Meat Church. They're pretty amazing.
Yeah, they're pretty awesome. All right.
Well, but if you have Altitude Home shirts, you guys have extras?
We might have some lying around that might be in a giveaway at some point.
Yeah, there we go. That's cool.
We've got mugs. We've got water bottles.
all the swag,
Yeah,
whatever
so,
you need.
Yeah. So send us a referral. We'll send you a shirt. All right, cool. Shift Happens shirt. Oh, that's probably Sherry saying that.
Yep.
Yeah. So at Keller Williams Mega Camp last week, they had a ton of cool shirts. None in fat guy sizes, so I didn't get any. But if I can figure out where I can get the designs for those shirts, I will make my own. But
There you go. That's easy.
I've always wanted a shirt with just John's face on it, and he still won't make it for me.
I mean, everybody wants that.
There you go. I like that.
I mean, that's my
sell.
retirement.
Right on the back.
That would sell. I like that.
Yeah,
That's cool.
that's my
Done.
retirement plan.
There you go.
All right, guys. Well, we'll call that the episode 2 in the books.
What?
I did forget to press record on the ATEM and on the Roadcaster,
Oh,
so double no recording, but we've got it online.
I was
So
going
it's all
to
good.
say.
It's all good.
Thanks, guys.
But
Appreciate you
thanks,
guys.
everybody. Appreciate you staying on, and we'll catch you on the next one.
Hasta la pasta.
Later.